The job market is losing momentum, even if it doesn't look obvious yet. What's slowing beneath the surface is starting to pressure everything tied to growth. Recent labor market data reflects a gradual deceleration rather than a sharp deterioration. Non-farm payroll growth has moderated from prior months, with downward revisions to earlier prints.
The latest jobs report shows the labor market is slowing down. The amount of jobs added came under economists' expectations, and the unemployment rate rose to its highest level in nearly 4 years. NBC's Ryan Noble shows us how the White House is responding.
Job openings, as measured by JOLTS, have declined from peak levels, while the quits rate has moved lower, indicating reduced worker confidence in job mobility. Initial and continuing jobless claims have edged higher, though not at recessionary levels. Wage growth remains positive but is easing on a sequential basis. The unemployment rate has ticked slightly higher, though still within a historically tight range. Labor force participation has stabilized, contributing to a modest rebalancing between labor supply and demand. Mechanically, this shift alters the Federal Reserve's policy calculus through the employment side of its dual mandate.
President Trump knows that we're super optimistic about the future of the jobs numbers because we're seeing a massive blowout in capital spending and new factory construction.
A cooling labor market reduces upward pressure on wages, which feeds into services inflation, one of the more persistent components of overall price stability. As wage growth moderates, the transmission into core inflation weakens, lowering the need for restrictive policy over time. At the same time, a slowing pace of hiring signals softer aggregate demand, which reinforces disinflationary forces. However, because the labor market remains relatively tight in level terms, the Federal Reserve is not immediately compelled to ease. Instead, the trajectory becomes the focus. Continued softening increases the probability of future rate cuts, even if policy remains unchanged in the near term. Liquidity conditions are indirectly affected as expectations for future policy easing begin to build, influencing forward rates and financial conditions before actual rate cuts occur. Across asset classes, the implications are directional and tied to shifting rate expectations. In U.S. Treasuries, a slowing labor market supports lower yields, particularly at the front end, as markets begin to price a higher probability of policy easing. This can lead to bull steepening if short-term yields decline faster than long-term yields. In equities, the impact is mixed. Lower rates can support valuation multiples, but weakening labor conditions signal potential downside to earnings, particularly in cyclical sectors. The net effect depends on whether disinflation or growth concerns dominate. In the US dollar, softer labor data tends to weigh on the currency as rate differentials compress, especially if other economies show relative resilience. In credit markets, early-stage labor softening may not immediately widen spreads, but continued deterioration increases default risk and weakens corporate fundamentals. Higher sensitivity emerges in lower-quality credit, where labor-driven income dynamics more directly affect repayment capacity. Overall, the transmission channel remains anchored in how labor data reshapes expectations for the Federal Reserve, which then flows through liquidity and discount rates into broader market pricing. Looking ahead, the key is whether labor market cooling remains gradual or accelerates. Continued declines in job openings, further moderation in wage growth, and a sustained rise in jobless claims would confirm a weakening trend. The unemployment rate will be critical as a threshold indicator. Any sharp increase would shift the Federal Reserve's stance more decisively toward easing. Conversely, stabilization in hiring or a reacceleration in wage growth would challenge the current trajectory. Upcoming payroll reports, wage metrics, and participation data will determine whether the labor market is stabilizing or moving toward a more pronounced slowdown.